Welcome to the Deep Dive, where we really try to cut through the noise and give you the insights that matter. Today, we're taking a close look at a pretty critical 24-hour outlook for the U.S. stock market. Specifically for today, July 1st, 2025, we've got this detailed market intelligence brief right here, and it's showing some conflicting signals. So our job today is to pull out the most important bits, make sense of these opposing views, and really help you understand what's driving things today, what might happen, and crucially, some actionable ideas for specific stocks.
Okay, let's unpack this. So the market really feels like it's at a crossroads today. We've seen the major indices kind of hang out at near all-time highs. It gives this feeling of maybe cautious optimism, but honestly, it feels really fragile. Like it's built more on momentum than, deep conviction. And the way we're thinking about this is using Bayesian inference. Basically, every piece of data today, and there's quite a bit coming, will adjust the odds of different market scenarios we've laid out. It's like fine-tuning in real time.
Exactly. And when you talk about data, today, July 1st, is just packed. I mean, potential market movers everywhere. We've got the ISM Manufacturing PMI for June coming out. That's the big one for manufacturing health from supply execs. Then there's Joe Altius job openings for May, which tells us about labor demand and construction spending also for May. But look, the main event, the thing that could just override everything else, it's Fed Chair Jerome Powell. He's speaking twice today, 9:30 a.m. Eastern, and again at 1:30 p.m. Eastern. How he interprets all this data, his specific words, that's likely going to set the direction. He's the ultimate arbiter today.
That's so interesting because the Fed itself hasn't exactly been singing from the same hymn sheet lately, has it? We just heard from Atlanta Fed's Raphael Bostic. He sounded pretty patient, maybe moderately hawkish. He's thinking just one rate cut this year in 2025, then maybe three in 2026. He kept stressing patience, mentioned tariff uncertainty, the solid job market. So that's one viewpoint from within the Fed. But then you've got Chicago Fed President Austin Goolsbee. His take was, a bit more nuanced, maybe makes things even trickier. He's sort of dismissed the whole 1970s stagflation idea, but he did acknowledge this possibility of both things getting worse at the same time, unemployment and inflation. And he really flagged the difficulty of dealing with supply shocks, like tariffs, and figuring out the source of inflation.
Exactly. And you've hit on the key point there, the source of inflation and the different levels of patience. This really sets the stage for why Powell's words today are just so critical. And this divergence gets even sharper when you look at the manufacturing surveys. This is where it gets really interesting. We've got this major contradiction. On one hand, the S&P Global Manufacturing PMI, the flash reading for June, looked strong, robust expansion. Held at 52.0, a 15-month high. Sounds great, right? But then you look at the ISM Manufacturing PMI. The May report was its third straight month contracting, down at 48.5. And the comments from the supply managers in that survey, they were talking about tariff-related chaos, demand uncertainty, things softening.
Wow, okay. So one says robust expansion, the other says contraction and chaos. That's some serious cognitive dissonance for the market.
Yeah.
How does an investor even process that? It must be creating a lot of uncertainty right now.
It absolutely is. You've got the S&P data suggesting resilience, but the ISM, talking to people on the ground, paints this picture of, turmoil and worry. And that's exactly why Powell holds the key today. If he leans into the S&P strength, sounds hawkish, justifies keeping policy tight, the market probably sells off a bit, favors defensive plays, staples, utilities, that sort of thing. But if he acknowledges the ISM weakness, maybe mentions those tariff concerns directly, the market could see that as dovish. And that might spark a relief rally, especially in those beaten down industrials and materials sectors.
All right, so if we try to pull these threads together, the Fed chatter, this manufacturing split, Powell's role, what are the main ways this could play out today? We've sort of mapped out three likely scenarios. Okay, first up, scenario A, hawkish hold. We think this has about a 45% chance. This happened if the ISM or JOLTS data comes in stronger than expected and Powell keeps hammering the inflation fight. We'd probably see the S&P to lower levels then. Then there's scenario B, neutral stasis. Maybe a 35% probability here. This is your mixed data outcome. Powell sticks to the wait and see script. Market probably chops around, stays in range. And finally, scenario C, dovish pivot signal. Lower probability, maybe 20%. This would need weaker ISM or JOLTS data. And crucially, Powell would need to acknowledge some cracks, maybe frame inflation as more supply-driven, hinting that the bar for cuts is lower. That could really ignite a rally, especially in growth stocks.
Yeah, exactly. And it's important to remember these aren't, guaranteed outcomes. They're probabilities. And the market's reaction, especially for individual stocks, won't necessarily be straightforward. Some stocks are just much more sensitive to these macro shifts.
That's a really good point. Because this isn't just theory, right? It connects directly to what you might actually see moving in your portfolio. We're trying to use first principles thinking here, asking, okay, why is this particular stock so relevant to today's news flow? Let's start with a big one. NVDA. I mean, this stock has become the market's main barometer for risk appetite, hasn't it? Especially in that high-growth tech space. Its price action today is probably going to be like an amplified version of whatever macro scenario plays out. A dovish signal could send it soaring, while a hawkish Powell could really hit it hard, given its valuation sensitivity. Plus, that whole AI narrative means anything Powell says about business investment or productivity is immediately relevant. And then there's Apple, AAPL, another giant, obviously. Key indicator for global consumer spending and super sensitive to trade policy, supply chains. That ISM report today, especially things like new export orders or comments on tariffs, that's a direct line to Apple's world. And Powell's tone on global growth, trade friction, particularly US-China stuff, which was a big theme in the last ISM report, that's critical for Apple too.
Right. And moving beyond those mega caps, we're really watching two specific mid-cap names today. They have company-specific news that ties directly into this macro story. First is MSC Industrial Direct, MSM. They distribute MRO products, maintenance, repair, operations stuff, mainly to industrial companies. So their sales are a really direct proxy for how busy the U.S. manufacturing sector is. And the key thing, MSM reports Q3 earnings before the market opens today. Their results, their guidance. It's an immediate real-world check on that ISM data that comes out later. Sentiment's already pretty weak on MSM, so it's definitely one to watch. Could be that double negative you mentioned earlier.
Oh, okay. So potentially confirming the ISM weakness even before the ISM number hits.
Precisely. And the second one is Constellation Brands, STZ. Consumer discretionary. Think beer, wine, spirits. Big imports from Mexico. So STZ is right in the crosshairs of two big risks: shifts in consumer spending and changes in U.S.-Mexico trade policy, especially tariffs. They report Q1 earnings after the market closes today, so this will be a test. How resilient is the premium consumer? And are tariffs squeezing margins? Options traders are already pricing in a big move, nearly 6% post-earnings. They're betting on volatility. Sentiment here is also leaning negative.
Okay, let's dig a bit deeper then, beyond the macro, beyond specific company news. What about the technicals? What are they telling us? I see the S&P 500's 14-day RSI, the relative strength index, is getting close to that 70 level, overbought.
Yeah.
Now, typically 70 means things might be getting a bit stretched, potential exhaustion.
Yes, and here's where it gets really interesting again, because that RSI reading presents its own crossroads, technically speaking. On one side, yes, overbought can mean exhaustion, maybe a pullback or consolidation is coming, but in a really strong uptrend, the RSI can actually stay overbought for a while. It just confirms the powerful momentum. So how do we read it today?
Well, it completely depends on how the market reacts to Powell and the data. A dovish reaction validates the momentum, maybe by the dips. A hawkish reaction validates the exhaustion signal, suggests the market's vulnerable.
And if we layer on some quantitative stuff, that Constellation Brands, STZ options market, is really jumping out. You mentioned the nearly 6% implied move. Short interest isn't huge, only about 2.2%, but the options market is clearly screaming event risk around these earnings.
Exactly. High implied volatility, high volume. Traders are actively placing bets that this stock is going to move significantly one way or the other. Makes it interesting for strategies that play on volatility. But now, let's talk about what might be the most critical factor today. This fragility in market sentiment. It's a really potentially unstable divergence we're seeing. You look at a first-order signal, like the ticker tape market mood index, it's way up at 72, deep in extreme greed. That reflects the recent price action, right? Indices hitting highs, FOMO kicking in, pulling more money in.
Right, the momentum chasing.
Exactly. But then you look at a second-order signal, something that measures actual investor conviction, like the AAII Sentiment Survey, the American Association of Individual Investors. And that tells a totally different story. Bearish sentiment is actually quite high, 40.3%, well above average. And bullish sentiment is below average at 35.1%.
Ah, so what does this all mean? Extreme greed on the surface, but underneath, individual investors are actually pretty cautious, even bearish. That sounds unstable. It means the rally is basically running on fumes, on momentum, not real belief.
That's precisely the interpretation. There's this surface greed driven by price action, but no deep well of bullish conviction underneath.
You know, it makes me think of that saying, be fearful when others are greedy. If we get a negative shock today, Powell sounds hawkish, ISM disappoints badly, that extreme greed could just vanish, couldn't it? And there's no real underlying support ready to buy the dip.
Exactly. It makes the market highly vulnerable to a sharp move down, a gap down, or a swift reversal if that momentum breaks. So, to pull it all together, the big conflict today is bullish technical momentum, the S&P near highs, versus this underlying bearish macro uncertainty. The weak ISM trends, the tariff worries, the cautious AAII sentiment, it could go two ways. Path 1, momentum wins. We get a dovish catalyst, weak data, Powell reassures, and the price trend continues. Path 2, macro uncertainty wins. We get a hawkish catalyst, strong data maybe, or Powell stays firm, revealing the rally was fragile, maybe even a bull trap. Look, the weight of the evidence as we see it suggests the market is in a fragile state. It seems more vulnerable to a negative shock than resilient to one. The sentiment divergence, the ISM concerns, Powell's key role, it all points to a higher chance of a negative outcome, or at least a cautious one. So our central thesis for the next 24 hours is basically neutral to downside bias. We're putting market confidence at maybe a 6 out of 10 on that view, with the risk clearly skewed lower. But our confidence is actually higher on some of those individual stock setups where the catalysts really line up, like that potential bearish trade on MSC Industrial. That potential double negative makes it compelling.
Okay, so this analysis isn't just about understanding the background noise. It actually leads to some specific actionable trade plans for you, the listener, with triggers, targets, stops, the whole thing. Let's focus on the 2 highest probability setups we see. First, that bearish idea on MSC Industrial, MSM. We're pegging this at around 60% probability. Remember that double catalyst MSM earnings before the open, ISM data shortly after. The trigger: if MSM misses on revenue or guidance, maybe blames tariffs or slowing demand, and the ISM number comes in weak, say below 48.5. Confirmation would be seeing the stock break below its pre-market low, around $83. Target, maybe $78. Stop loss, around $85.50. Second idea, bearish on Constellation Brands, STZ. Probability may be 50%. A driver here would be an earnings miss or guidance cut after the close, likely citing margin pressure from tariffs or a slowing consumer. Trigger is that miss. Confirmation: if the stock gaps down after hours and stays below, say, $158. Target could be $148 with a stop around $161. These are spots where multiple factors seem to align, giving a potentially clearer edge in what looks like a messy day.
And just to take it one step further, thinking strategically, consider those earnings reports today, STZ, MSM, and maybe others like Greenbrier in related sectors. They aren't just about the individual stocks. They're like canaries in the coal mine, signaling the real-world impact tariffs are having across corporate America. If we see multiple companies across different sectors, consumer goods, industrial manufacturing, distribution, all reporting significant margin hits and explicitly blaming tariffs, that's a powerful signal. It suggests a systemic issue, not just isolated problems.
That's fascinating. So it's not just about trading MSM or STZ today. What's really interesting here is this could be a signal for a proactive trader.
Yeah.
You can almost build what are we calling it? A tariff contagion basket.
Exactly. The idea is if you get confirmation today from these early reporters that tariffs are biting hard, you could then initiate short positions in other tariff-exposed companies before they report, before the market fully prices in this systemic risk across the board. Think auto parts, other food and beverage companies, appliance makers, industrial equipment firms, companies reliant on imported steel, aluminum, etc. You're essentially playing the information lag, using today's specific news as a forward-looking indicator for a broader theme.
That's a really powerful second-order thought process, using today's micro to inform a broader macro strategy.
It is. But for today, specifically, our highest conviction setup remains that bearish MSC industrial trade, just because of that tight alignment of the micro catalyst earnings and the macro catalyst, ISM. So wrapping up, today is definitely not shaping up to be a quiet day. It really hinges on Powell, how he interprets these mixed signals and how that message flows through the market. The market feels fragile, as we've discussed, but that fragility also creates opportunity if you can leverage the insights from this kind of deep dive.
Absolutely. So here's a thought for you as you watch things unfold today. What will you be watching most closely? How will you use this insight, this potential tariff contagion theme, to maybe refine your own view on where the market's heading and where real opportunities might lie? Today, ahead in this kind of dynamic market, make sure you subscribe to The Deep Dive. We'll bring you the fastest updates and analysis